Hey guys, welcome to another live stream. I have a very big topic for you guys today, and I'm sure you guys are not going to be disappointed. So, let's begin with Warren Buffett's big secret, intrinsic value. How does he do it? How did he get his $83 billion? Here's the answer to all of your questions, okay guys? Intrinsic value is the big secret. So, what is intrinsic value? Intrinsic value is the expected and projected annual compounding rate that an investment can produce. Warren Buffett uses intrinsic value to determine if an investment makes business sense to buy shares of. Business sense meaning that he can expect that it will gain a good return on his investment over time. Warren Buffett also makes long-term investments in businesses that he expects their future earnings are quite predictable to a high degree of certainty. Now, how can he expect the company to go up if it's really kind of unpredictable? That's where you're wrong. It's quite predictable. I think that it's pretty easy to find out. And there's a special formula for intrinsic value. First, we're going to review on how do you figure out whether a company is worth investing using the intrinsic value. There's a lot of ways to figure out if a company is worth buying shares of or not. Let's dive into them. Reason number one, company has to be very predictable. Let's put Carnival Cruises for example, okay? I'm going to be using this company a lot in this video as an example and reference. Carnival Cruise was at 54 per share before COVID. Now it's 20 and it's struggling to keep 20. So what's happening there? Well, put a guess. COVID. People don't want to go on a boat because they're afraid of getting it. So if you're afraid of getting COVID, you're not going to go on airplanes, which means you're not going to go traveling. If you're not going to go traveling, you're not going to go on a boat either. So this is really hurting their company, which obviously lowered their company worth. But its intrinsic value says that it could potentially go up. And yes, Colin, I do see your comment. All right. The second reason is that excellent business economics have to be profitable. So if the company has a good profit margin, so for Carnival, we would consider its past record. Was it making money back then before COVID? It was. Third thing, it has to be a consumer monopoly. So this means that it has strong earnings, it's consistently moving up, and its management is functioning with the shareholders' interests in mind. This means that they're working for you. They are really focusing to make you wealthy. They're not in it for themselves. Okay? I mean, of course they are, but like they're also in it for you. And so this is an important thing that Warren Buffett considers himself before buying a share. That this company has to be run by people that really know what they're doing and they're in it to build the whole company up. The fourth criteria, you could say, is that there has to be a low price. If you're buying at the big spike top, or if it's climbing like this, that's a horrible time to buy. I get it's exciting. You think, okay, if I buy here, then it might jump up to here. You're wrong. It oftentimes doesn't. It oftentimes turns around as soon as you buy it. That's what happened to me several times already. Boyo Shorts asked me, am I sticking with streaming for now? The plan is that I am going to be doing weekly streams, maybe twice a month, but roughly every week. And I'll be talking a little bit about investing here and there. And then I'll be making several fun videos, you could say, along the way for entertainment purposes. I kind of like having a mix. All right. And so the fifth criteria is that the business type and price, expected rate of return, all three of those things should be the big determiners on your buy. This is important, guys, because if you're investing in some business type, for example, let's say you're investing in some commodity like oil, okay? Oil is running out. There's not going to be oil in 50 years. This means that if you invest in them, they're probably going to decline over time, okay? This stuff is predictable. Their expected rate of return in the short term might be up, but in the long term, you can't expect it to be up. So this should all determine your buy. For example, Amazon, they're expanding their online buyers, their audience in America. They're replacing malls. For goodness sakes, guys. This is a big deal. People are not going Christmas shopping. They're going online Amazon shopping. And that is making me money. You want to be a part of that? I think you do. So investing at the right prices in businesses, exceptional economics will produce over the long term at least 15% annual compounded growth. What does this mean for you? This means that if you buy business at the right price, below its value, it means that you can expect that over a year, it will gain you at least 15% growth. Compounded. You know what that means? It means that you're 15% wealthier than you were the year before. Not the first year, but every single year. This means that it's getting bigger. You're growing faster than you were before. Hey guys, it's a big deal, and Warren Buffett really values this. Benjamin Graham was Warren Buffett's university professor and also his mentor. He believed that the value of a company didn't matter as much as long as the price per share was a bargain deal, and if it was low enough to make a good profit. The whole goal of investing is to buy low and sell high. And that's the goal, guys. You do not buy on the big spike of the trend. It's exciting, guys. It's exciting, but it's not the right thing to do. You buy it when it's low, when everything is looking all doom and gloom. When it does, it means it only has up to go. If it's all the way up here, it has all this to lose. That's not a good way of doing things. I've made a mistake before. I do not want you guys to experience this. So, back to Benjamin Graham, who was Warren Buffett's university professor and later mentor. He believed that if you could buy a mediocre company at a great price, you could make good earnings. And Warren Buffett believed this for a while, and he found different results. What he found is that you cannot keep this steadily. You might make good gains near term, but in the long term, you're bound to lose. And maybe not necessarily bound, but you are not likely to keep up that growth for a long period of time. And that's what Warren Buffett likes. He has beat the market for over 50 years. How? He invests his own strategy. He does great quality companies, excellent, top of the top, for good prices. Not bargain, good. Because bargain prices are even lower than good, are very rare. So if you can get a good price for a company, that's it. That's all you need. And later in this video, I'm going to teach you how to find out if the company is a good buy or not. This is probably the most valuable investing lesson you may ever learn. So stick around. All right. So there's very few company stocks that can boast their safe growth and give high gains. For example, the government bond can only give you 0.5% a year at this current time. That's not very much at all, guys. Not very much. It's safe, but you're not going to get rich over 0.5% a year. Okay, guys, you got to focus on real companies, guys. That's growth. So companies like Amazon and Apple are of great interest to Warren Buffett because he knows that these companies are less likely to fall significantly and they have good yearly growth. Those are the two big criteria, guys. They have to be safe, steady, others are not likely to go down. And they have to have a good spread. They have to grow significantly. All right, so now I'm going to get into the magic formula, guys. From this book right here, Buffettology. The Secrets of Warren Buffett, Unexplained Secrets. Yes, boyo shorts, I will be explaining that in a very short amount of time. I totally recommend this book. It's by Mary Buffett, his daughter-in-law, and what she wrote about him was not, Warren Buffett did not approve of this because she learned everything from him, all of his investing secrets. She wrote that in that book. It's free in the library right now. Okay, guys? Why not get it and learn to be 10 times the investor you were before picking up the book? All right, guys, let's get right into intrinsic value. Intrinsic value is the future projected worth of a company. Okay, guys, so you can find this with a special formula I got right here. This is an example for Carnival Cruise Line. Its company market cap is the full worth of the company. Okay, guys? So that means that if they sold every single thing that they own of that company, it'd be worth $23.69 billion. That's a lot of money, guys. And how many shares is that? If they sold all of their shares, 921.3 million. So what does this mean, guys? This means that you can find out what its price per share should be. Let's look at it. Its intrinsic value is the price of the company divided by the amount of shares. This is $25.7 per share. Let's look at the current price per share, and we're going to determine if it's a good buy or not. Carnival is currently $21.59. See that? You know what this means? This means that the difference between 21.6 and 25.7 is 18% growth. You know what I did there, sir? I predicted the future. And you can too. That's true. If you know to find the worth of the company, divide it by the amount of shares, you find out what its worth should be. Now, why did it fall below that? Good question. The market in the short term is pretty much a big voting machine. It's people deciding, oh wow, it's a great price, let's buy. Or, oh no, it's the end of the world, sell. But in the long term, the market is a big voting machine of quality. Only the quality companies are going to grow significantly. And with a game like this, with all this information that was provided by the company to the public, it means that they're all open doors. They're honest. And this is a sign of quality business. I expect even more than that, as a matter of fact. I bought Carnival at 17. My gains are about 35%. What could it be for you guys in a year? Well, with the end of COVID, it could go right all the way back up to 54 per share. You know what that means for you guys? It means your money will more than double in a year. Now, you might think, okay, I put $100 of my life savings in there and it becomes $200. So what? Well, imagine if you were living off of this investing money. You decided to retire early. You knew that this company would gain 18% minimal growth in a year. Live off of that. They even pay dividends. At least they used to before COVID. Once COVID's over, I suspect they'll go right back to it. And you benefit from the spread. Big deal, guys. This is the secret of big growth. Remember this formula. It is the worth of the company divided by the amount of shares. This is Warren Buffett's biggest secret. His biggest secret of all is determining if the price of the company is worth buying. If it's below its intrinsic value here, it's a buy. If it's above, it's a sell. So that's it, guys. I hope that I teach you something extremely valuable today, because in my eyes, and I learned this about a week ago, I learned all of this. I am double the investor I was a week ago just because of this. This is valuable stuff. Very valuable. I'm going to be using this formula in every investment that I do in my entire life. Just find the worth of the company, divide it by the amount of shares. That's its future worth. It may be below the current, and it may be above the current. It all depends on that. If it's above its current worth, buy it. If it's below the current worth, that's a sign not to get in at all or sell. That's it, guys. I hope you learned your lesson, and have a great night, guys. If you have any questions, I will give you guys a few seconds to come up with one. You guys want me to review another company with you guys really quick? All right, we're going to look at Datadog now, if you want. So, actually, no. We'll look at a popular one. We'll look at Tesla, okay? Tesla, the big question of the day. This company is all over the place. It's gained like 500, 600% this year. That's really huge earnings. So, I'm on Yahoo Finance. Excellent free app. Okay, so you then get onto the statistics of the company for Tesla. So it's loading, but I'm about to see what the whole company in itself is worth. Then I'll tell you guys how many shares and overall what is it worth. So the company's market cap, which is its full worth, is $658.8 billion. Whew. What a mouthful. That's a ton, guys. That's a ton. All right, 658.8 billion. Then its amount of shares, 947.9 million. All right, guys, this might scare you guys. All right, 47.9. All right, so from what I got from this, Tesla is actually worth more than its current price of 677. You know what this means? This means that Tesla is a buy. Tesla is going to gain value in the short term. It will not be nearly as good as Carnival's 18%, but it will gain a few percent in the very short term. Hey guys, this is a good sign. That could mean a buy. All right, guys, I have taught you guys big lesson of the day, and I believe this could even change your whole investing career. I hope I helped. All right, guys, thanks, and see you on the next video.